All right, this is Milad. Time now is 8:12 p.m. on January 30th. That is New York time, as they say, Eastern time. Just want to review some price action. Economic calendar today. There was a moderate news at 9 and high impact news jolts report at 10. So you can kind of keep that in mind when dealing with the market. And start at DXY, the dollar, and we could already see that the market opened, or the day, midnight, going from midnight, that the price opened up within the range of the previous day, meaning that it opened up between the previous day's high and the previous day's low. So that's the range. Right, so we have a break. Price ran these relative equal lows here. Ran up into this fair value gap, bearish fair value gap. Short, ran this low again. So we ran this low first, then the Asia session, London session, we traded into this bearish fair value gap. Right. Came down, ran this sell side here, came back up into the same bearish fair value gap, and also took out this swing high. And now we are here. So we definitely still technically traded within this, traded within the previous day's range. We broke out the range, traded back inside the range. Keep that in mind. See what happened at 9. Let's drop down, then we can see 9 o'clock. 9 o'clock news, market pulled down, took out these this swing lows here, like we noted. 10 o'clock news, quote unquote high impact news. We have this push higher, took out this swing high, this swing high, and this swing high into this fair value gap and pull back down. So you can actually either took this bearish fair value gap or this inverted fair value gap here, which is you can call it a balanced price range. This has its rules. You can literally choose which one you want to use, but this is a higher probability setup. If you have these a bullish fair value gap in the same zone as a bearish fair value gap, and probably could have worded that better, but hopefully that's clear. So let's get rid of that because so many lines on the chart. So yeah, relatively tight range, definitely tradable on the lower time frames. When you have these tighter ranges, by default you want to become more of a scalper instead of a long-term like day trader, unless you see a technical pattern, some type of influx of volume or some type of catalyst that may push price outside of the range. Then have to be cautious. Oh, that ain't work. I knew that already. Okay. Start here on the daily. This is the NQ daily chart. NASDAQ. And this is something I noted yesterday, and around the time that I said this swing high, the market that referring to Monday, that it took out the swing low and the swing high, and then I said something's gonna happen. Then I said something is always going to happen, right? Then this is what I was referring to, some type of so this is all bullish, but once this happened, to me at least, we should see some downside action. But nothing in life is guaranteed, so that's just something to take note of whenever price runs both the swing low and the swing high in the same day. Then kind of like be a little leery and just kind of keep that in mind for your own trading strategy. Then we have a liquidity void or a volume imbalance that's formed after that. That's also like an indication that price may be in a hurry to go down. I'm not saying how far down. I'm not even saying it's going down. That's for you to determine. I'm just saying what these candlesticks are telling me. And could very well just trade into this fair value gap, bullish fair value gap, and then proceed to the upside. There you go. How's that for balance? So we drop down to a 4-hour. You can see, what's fascinating about these PD arrays that ICT introduced us to is that when in the beginning I used to mess up a lot, right? A lot of us mess up a lot in the very beginning for various reasons. One reason is we try to combine every system together, but also when you hear about PD arrays, you think like, oh, price used that already and it's done. Or like, it took me a while to realize that PD arrays work initially when they can form right then and there and work like almost immediately when price kind of like pulls back into it, or it can work later on, and that whole time I used to just look for the later on and not realize that price is like using these PD arrays as like stepping stones to get where it needed to go immediately, though, not just later on, right? But anyway, so drop down to a 1 hour. That's because we had this setup last night. Well, I didn't identify setup, but I identified this PD array. That price was having trouble getting above it, and I drew this one today. London session. It's not London session entry on the 1 hour chart. You could use this bearish fair value gap or this one that formed here. You have this trade back up. You have a pull down and a 4 o'clock candle. You have a 3 o'clock candle go up, pull down, and you have the 5 o'clock candle retrace back into this fair value gap on the 1 o'clock candle on the 1 hour chart. All right, so you can drop down. So this was you have your run on stops here, trading into a bearish fair value gap here on a 15-minute chart. Here's your break and market structure. Here's your retrace back into this 15-minute fair value gap or this 1 hour. You get to choose now, right? And here's your push lower. Here's your fair value gap, break and market structure or run on stops, retrace back into that fair value gap. And this is during the New York AM session. So also keeping in mind the same notes of how we discussed the DXY or the dollar, that when the market, you want to again identify where is price at in relationship to the previous day, high and low, and you can see we open up within the range of the previous day. So yeah, I had to keep that in mind. Likewise, keep in mind the range of the previous session, right? Previous session highs and lows. So you see price took out the London low here and continued. Took out the Asia low, traded back up and technically into the Asian range. Pulled down, took out the London low, and then just kept taking out the previous days. PM session, AM session, previous days, you want to call that the London session, and let's say Asia session, and then the London session here. Relative equal lows. And we have this low way back here, New York AM session. That's 1, 2, 3, 4, 5 days ago. 5 days ago. And you can see here we are inside of a bigger range. So sometimes it pays to pay attention. You can see here optimal trade entry short using this entire range. And we can tighten that up, of course, by using the bodies. And I like to eyeball everything, so don't mind me. All right, so see that? And there's no significance. I'm not placing any significance on the Fibonacci itself, but if you wanted to use some type of levels, then you can see like price traded into the level, broke through, retest the level, did it again, broke this level, retested, dropped through with force, came back up, approached it, fair value gap, continued down. Market maker sell model. Original consolidation, I would say, would be here. You got 1, 2, 3, right? Low risk buy, another low risk buy. Group all this in, or 1, 2, 3, and then blast through this consolidation here. Where we at? All right, now you're gonna see this sick ES, right? Didn't want to do much until this is a 5-minute. Didn't have as much range expansion as the NQ did, but you can. This is the 15-minute. Let's go to the 1 hour just for. And you can see here. What's this high here? Relative equal high. So for me, that says that's a target. Eventually, soon, perhaps. That's a target. And you have a small, tiny little fair value gap here. Inverted fair value gap. Inverted fair value gap. And you can see price traded into it here. Burst right through it. Ran this swing high. And drop back down. And this is the point that I mean, like, sometimes you may wait for price to come back like all the way over here, right? Like a retracement before it hits this to go down. And like, look how close it is to here. Retrace, consequent encroachment, couldn't hold above it. That's your entry, short. So you don't necessarily have to drop down, but why not, right? And here's my 1, 2, 3 pattern, which means that it didn't have to take out this liquidity, because this is it taking out liquidity, right? I think the more that you trade a certain type of setup and you don't deviate, the quicker you can see your trade setup and your potential entries and your exits. So even though this was like choppy, these are still setups here. This is a 15-minute chart. This is a 1 hour fair value gap like we just identified, and we see price trade above that bearish fair value gap at the time. 1, 2, 3 into the previous day's high. Didn't break it, as we can see here, same, and then dropped. With this entry would be at the during the macro F315 to 345. So time then price. Time then price is important, and expecting, like all day, this is just not really motivational, right? Still tradable though. And here's the 5-minute chart. And you can see here we have an inverted fair value gap. So we have a run on stops. Let's draw that out. Have a run on buy side liquidity. Buy side liquidity is rated with this. You have a break in market structure here. That's definitely off, but we could fix that. All right, here's your market structure shift. Market structure shift. Here's your fair value gap. I'm gonna just erase this just so you can see more clearly. There you go. Right? There's your entry. So let's see. Again, this is the range, kind of like the range that price been in like all day, right? So you can use that too, right? Except it's bullish, right? It's bullish this whole time till price breaks below it and becomes an inverted fair value gap right here. And then we get into, you can do it yourself if you want to be more accurate, but let's see, we can put 25%. You can see there, right? The point here, let me not do that to you. Sometimes you think, oh, it's clear to me, so it's clear to everybody, and it's not the case. So let me just take all this off. 50, let's see how it is. And let's put 75. All right, so here's your quarters of this fair value gap, and this is a 5-minute chart. After we already noted that we are in this range here, and you can just see prior to price reacting to that level, consequent cross middle to midway point. Still, price broke beneath it. Volume imbalance is here. Came back up. Anyway, that's obvious, right? Whatever. This is the quadrant. So you can see the retracement price didn't want to go back. Is too weak to go above, even to the consequent cross middle, the midway point, and it couldn't hold above 25% of this 5 minute. At this point, an inverted fair value gap here. So let's just change that to. Let's change that to leave that red and change the to orange. Gray, charcoal. All right. So you had an entry here, after hours, 6:15 to 6:30 maybe. Here, 6:55. So you had an entry here, and you had this entry here. Last macro, 3:45 to 4 p.m. You have this entry, and there you go, the 4 p.m. candle. So you got like 3:15, 3:45 macro, and you have 3:45 to 4 macro. It's a couple of different macros. My favorite one is the 3:15 to 3:45, and then 3:45 to technically 4:15. But 3:45 to 4. You can look that up yourself. ICT macros. I'm not trying to change the game. I'm just trying to say what works best for me. I try to get out of trades by 4, right? You can hold on to it if you want, right? So whatever. So yeah, run on buy side, A+ setup for me. Run on buy side, market structure shift, retrace into either a this is technically an inverted fair value gap as well. Retrace into an inverted fair value gap or a fair value gap on the price like that caused a market structure shift. So it's pretty simple, right? It's like 3 or 4 rules. Only using inverted fair value. Run on stops, market structure shift, and the retracement or pullback into a inverted fair value gap or a fair value gap that's within the range of the market of the price like that caused a market structure shift. What is that? 4 rules? 4 rules? 4 or 5 rules? And then you target swing lows or the internal range liquidity, external range liquidity. So there you go. I don't know how much sense any of this made. I feel good about it. Anyway, we covered the dollar, we covered the NQ, we covered the ES.